Imagine a mighty river, once the world's unchallenged artery of global commerce, begins to change its course. It doesn't vanish overnight, but instead, tributaries quietly carve out new paths. Today, I want to talk about that river, the U.S. dollar, and how, in plain sight, central banks are redirecting their flows, step by careful step. Over the past few decades, there has been a subtle but undeniable transformation in the way the world holds its wealth at the highest level of finance. If you track the composition of central bank reserves over time, you notice something that most people miss because they're focused on headlines and short-term fluctuations. The U.S. dollar, which for decades was the overwhelmingly dominant currency in global reserves, has been gradually losing share. In 1999, it made up roughly 71% of the world's disclosed foreign exchange reserves. Today, that figure is under 60%. The decline hasn't been a cliff, it's been a slow, steady erosion, almost like watching a glacier retreat year by year. And it's in that slow pace that most people fail to register the significance because it doesn't feel like a crisis. But these are the kinds of changes that reshape the foundations of the system over time. When you understand how central banks think, the pattern makes sense. They don't move fast unless they're forced to, because they manage national balance sheets with decades in mind, not quarters. Shifting reserves is like steering a massive ship. It takes a long arc to change direction. But over the past 20 years, one of the most consistent arcs has been the diversification away from the dollar. This is not happening because the dollar suddenly became useless. It's still the most liquid, most widely accepted, and most institutionally trusted currency in the world. It's happening because the calculus of risk and opportunity has changed for many nations. Holding too much in a single currency, even one as dominant as the dollar, creates vulnerability. The 2008 financial crisis, the European debt crisis, and more recently, the use of the dollar as a tool of sanctions and political leverage have all reinforced the lesson that concentration risk is real. Central banks are not dumping the dollar, they're trimming it. They're building a more balanced portfolio of reserves that might include the euro, the Japanese yen, the Chinese renminbi, and increasingly, physical gold. If you look closely, gold has quietly reemerged as a strategic reserve asset. It has no counterparty risk, it isn't tied to any one nation's policies, and it has a track record that extends back thousands of years. For some central banks, particularly those outside the U.S. alliance network, it offers a level of neutrality that currencies simply cannot. Another layer to this shift is geopolitical alignment. The global landscape is moving from a unipolar order, dominated by one superpower and one reserve currency, to something more multipolar. Trade patterns are diversifying, new financial networks are emerging, and technological advances, like central bank digital currencies, are creating fresh settlement channels that reduce the friction of transacting in multiple currencies. In such an environment, it's logical for reserve managers to reflect that diversity in their holdings. It's also worth noting that the decline in the dollar's share doesn't necessarily mean a proportional rise in any single competitor. In fact, much of the shift has gone into non-traditional reserve currencies, those outside the top four, and into gold. This suggests that the move is less about replacing the dollar with one rival, and more about building a basket of uncorrelated stores of value. That is a very different dynamic from the Cold War era, when the competition was primarily a binary one between the dollar and the Soviet ruble. The long-term implication is that the world's monetary order is becoming less concentrated and more resilient to the fortunes or misfortunes of any one nation. That's a positive in terms of global stability, but it also means the U.S. can no longer assume the same automatic demand for its currency that it once enjoyed. For investors, for policymakers, and for businesses operating internationally, this shift matters. The process is slow, and because it's slow, it's easy to ignore. But history shows that the most important changes in the financial system often begin quietly, almost invisibly, until they cross a tipping point. By the time the mainstream conversation catches up, the new reality is already in place. That's exactly what's unfolding right now with the world's reserve composition, an unhurried but transformative redistribution of trust. One of the least appreciated but most powerful forces shaping the global monetary system is the way political risk has become intertwined with currency holdings. A reserve currency is not just a medium of exchange, it's a symbol of trust in the issuing country's economic, political, and legal systems. For decades, the dollar benefited from an almost unquestioned presumption of safety. Holding dollars meant you were holding assets that were protected by the rule of law, backed by the largest economy in the world, and anchored to the most liquid markets. That trust is still there, but cracks have begun to show, not because of a sudden collapse in U.S. fundamentals, but because the currency has been increasingly used as a lever in geopolitical strategy. When a nation uses its currency as a tool to achieve political aims, it sends a message, intentionally or not, that the asset is not entirely neutral. The freezing of foreign reserves, the exclusion of countries from the SWIFT payment system, and the expansion of economic sanctions have shown the world that dollar-denominated assets can be made inaccessible if a country falls out of political favor. For allies, this may seem like a distant, hypothetical concern. For non-aligned nations or those with strategic rivalries with the U.S., it's a direct wake-up call. It's not about agreeing or disagreeing with the policy. It's about recognizing that the safety of reserves is contingent on political alignment. Central banks, by their nature, plan for extremes, not averages. They don't need to believe that their reserves will be seized tomorrow to see the logic in diversifying. If you're responsible for safeguarding your nation's wealth for decades to come, you have to consider the possibility, however remote, that the currency you rely on could one day become a liability. That's why political risk is not just a topic for diplomats. It's a core consideration for reserve managers. The past few years have amplified this awareness. The freezing of Russia's foreign reserves in 2022 was a watershed moment, regardless of the geopolitical circumstances. It demonstrated in real time that the reserve status of a currency does not make it immune from being used as a geopolitical tool. The same sanctions architecture that was designed for targeted, tactical measures became a reminder of the structural power the U.S. holds, and by extension, the potential vulnerability for those on the other side of that power. Beyond sanctions, there's also the question of internal political dynamics within the U.S. Political polarization, fiscal brinkmanship, and debates over debt ceilings and government shutdowns have raised questions abroad about the stability and predictability of U.S. policy. While the U.S. still offers a far more transparent and liquid financial environment than most alternatives, central banks cannot ignore the trend toward greater political volatility. If part of the appeal of a reserve currency is its insulation from short-term political drama, then erosion of that insulation inevitably pushes reserve managers to think more broadly about their allocation. This doesn't mean an abrupt flight from the dollar. It means a rebalancing of risk. More holdings in euros, renminbi, yen, and especially gold serve as hedges against the possibility of political disruption in any single currency system. Gold, in particular, is attractive in this context because it's immune to political weaponization in the same way currencies are. No government can freeze a bar of gold stored in your own vault. The shift we're seeing is not an emotional reaction, it's a rational recalibration. The dollar is still the core pillar of global reserves, but it's no longer assumed to be untouchable. The understanding now is that any currency's value as a reserve asset is inseparable from the policies and politics of its issuer. As that awareness grows, so does the motivation to ensure that no single political system holds the keys to a nation's entire financial future. For most of modern history, the concept of reserve diversification was treated as a secondary consideration, something you did at the margins, not at the core of your strategy. The dollar's dominance made it seem unnecessary to hold much else, and when other currencies were added, they were typically small allocations meant more for operational convenience than for strategic risk management. That thinking has shifted. In the last decade, diversification has become a central pillar of how central banks structure their reserves, and the mix they're turning to reveals a lot about the world they see coming. The most notable trend is the broadening of currency holdings beyond the dollar. The euro remains the second largest reserve currency, and while it has its own set of challenges, it offers deep and liquid markets, political cohesion among member states, and the scale to be a meaningful counterweight to the dollar. The Japanese yen, despite low yields, plays a role as a liquid and relatively stable currency, especially in times of global market stress. The Chinese renminbi, although still a small share of global reserves, is gaining ground because of China's expanding share of global trade and its efforts to build out alternative payment systems. Even currencies like the Canadian dollar, Australian dollar, and Swiss franc are getting more attention, not because they can rival the dollar's scale, but because they offer exposure to different economies, commodity bases, and political systems. Yet, perhaps the most important part of this diversification story is not about other currencies at all, it's about gold. Gold has reemerged as a core reserve asset in a way we haven't seen since the Bretton Woods era. In surveys, central banks consistently cite gold's lack of credit risk, its historical role as a store of value, and its independence from any single country's monetary policy as the main reasons for increasing their holdings. Gold's behavior in times of crisis reinforces its appeal. It tends to rise when confidence in paper currencies is under strain. For countries that want to insulate themselves from the political and financial policies of any one nation, it's a uniquely neutral asset. The recent wave of gold buying by central banks is telling. In 2022 and 2023, purchases hit multi-decade highs, with emerging market central banks leading the way. This wasn't simply opportunistic buying because prices dipped. Much of it came during periods when gold was already trading at historically elevated levels. That signals a strategic, not tactical, decision, willingness to accept higher entry prices in exchange for the security and independence gold offers. This broader diversification is also a response to a world that is becoming less predictable. Trade relationships are shifting, supply chains are being restructured, and alliances are evolving. A reserve composition that reflects only one major currency leaves a nation exposed to the fortunes and the political decisions of that currency's issuer. By spreading holdings across multiple currencies and into gold, central banks are effectively hedging against a more fragmented global order. It's important to understand that this is not a rejection of the dollar, but an adaptation to a new reality. The dollar remains indispensable because of its liquidity, network effects, and entrenched role in global finance. But the world is moving toward a reserve landscape that is more balanced, where no single currency has an overwhelming majority share. That shift doesn't happen overnight. It's an incremental process measured in basis points per year, but its direction is clear. In the long run, this approach to diversification could make the global financial system more resilient. A world where reserves are spread across several strong currencies and into neutral assets like gold is less vulnerable to the political and economic shocks of any single country. It also reflects a deeper truth. In an environment where uncertainty is growing, the cost of concentration is rising, and the premium on flexibility has never been higher. For most of modern history, diversification in reserves was an afterthought. The dollar's dominance meant that holding other currencies was often a token gesture, done at the edges rather than at the core of a strategy. That mindset has shifted. Over the past decade, central banks have moved diversification from the periphery to the center of their reserve management, and the choices they're making reveal how they see the future unfolding. A clear pattern is emerging in the data. Holdings are broadening beyond the dollar. The euro remains the second largest reserve currency, offering deep markets and political cohesion despite its own challenges. The yen, even with low yields, still serves as a liquid and dependable store of value during global market stress. The Chinese renminbi is gradually carving out a larger role, powered by China's expanding trade presence and infrastructure for alternative payment systems. Even smaller currencies, the Canadian and Australian dollars, the Swiss franc are finding a place, offering exposure to different economies, commodities, and political systems. Yet the most striking element of this diversification isn't a currency at all, it's gold. Gold has stepped back into the reserve spotlight in a way we haven't seen since the Bretton Woods era. Central banks consistently point to its immunity from credit risk, its historical role as a store of value, and its independence from any single government's policy as reasons for building their holdings. In volatile times, gold tends to hold its ground or rise, making it a natural hedge. Its neutrality gives it unique appeal for countries seeking insulation from the policy decisions of others. Recent gold buying trends are telling. In 2022 and 2023, central bank purchases reached multi-decade highs, with emerging markets leading the push. Much of this buying occurred even as prices were elevated, showing a strategic intent. The goal wasn't short-term profit, but long-term security and sovereignty over reserves. This diversification drive is a direct response to a more unpredictable world. Trade routes are shifting, alliances are evolving, and the geopolitical map is becoming more complex. Concentrating reserves in one currency ties a nation's fortunes too tightly to the political and economic trajectory of its issuer. By allocating across multiple currencies and gold, central banks are essentially building a hedge against a more fragmented, multipolar global order. None of this means abandoning the dollar. It still holds unmatched liquidity, network effects, and deep market infrastructure. But the path is toward a more balanced global reserve mix, where no single currency dominates to the extent the dollar once did. The transition is slow, measured in small percentage changes each year, but the direction is unmistakable. In time, this broader approach could strengthen the resilience of the global system. Distributing reserves across several strong currencies and a neutral asset like gold makes the whole less vulnerable to shocks from any single source. It reflects an important reality. In an era of rising uncertainty, the cost of concentration is climbing, and the value of flexibility has never been greater. In a world where the dollar is still dominant but no longer unchallenged, the search for alternatives is becoming more deliberate. The euro, the Chinese yuan, and the emergence of central bank digital currencies are each playing distinct roles in this transition, not as immediate replacements, but as building blocks of a more diversified and competitive reserve landscape. The euro, despite its own structural issues and the complexity of governing a monetary union of sovereign states, continues to stand as the second pillar of global reserves. It offers depth, liquidity, and a legal and institutional framework that inspires a degree of trust similar to the dollar, especially among countries with strong trade ties to the European Union. Its resilience through crises, first the sovereign debt turmoil, then the pandemic, has proven that it can weather significant stress without breaking apart, which is a quality central banks value in a reserve asset. The Chinese yuan is on a different path. It's not yet a fully convertible currency, and capital controls limit its integration into the global system, but its growing role in trade settlement is undeniable. China has spent years building out financial infrastructure, signing bilateral swap agreements, and encouraging commodity trade, especially in energy, to be denominated in yuan. The launch of alternative payment systems and networks independent of SWIFT further signals Beijing's intention to reduce reliance on the dollar in cross-border transactions. For countries deeply integrated with China's supply chains or seeking to hedge against U.S. financial leverage, holding yuan as part of reserves is becoming a strategic choice, even if the market depth is still developing. Then there's the more experimental frontier, central bank digital currencies. While they are still in the early stages, they represent a structural shift in how money moves across borders. CBDCs could eventually bypass traditional correspondent banking channels, reduce settlement times from days to seconds, and create direct lines between central banks. If widely adopted, they could make it easier for countries to transact in their own or preferred partner currencies without routing through the dollar. The potential here isn't about replacing the dollar overnight. It's about creating an infrastructure where multiple currencies can operate in parallel, each with equal technical footing. The combined effect of these developments is a slow erosion of the dollar's monopoly on trust, access, and infrastructure. The euro offers a like alternative in terms of institutional depth. The yuan brings strategic alignment for a growing block of economies, and CBDCs could level the playing field technologically. Taken together, they point to a future where the reserve system is more fragmented, with flows shifting according to trade relationships, geopolitical alignment, and technological capabilities rather than defaulting automatically to the dollar. Central banks don't view these alternatives in isolation. They're looking at how each fits into a broader strategy of risk distribution. The euro's appeal is its stability and familiarity. The yuan's is its link to the world's second largest economy. CBDCs offer optionality in a digitizing world. A balanced reserve portfolio can incorporate all three in varying degrees, reducing overdependence on any single system or political center. This is not the end of dollar dominance. but it is the beginning of a new era where it has to share space. In the past, competition among reserve currencies was limited by the constraints of settlement systems and liquidity access. Now, with technology reshaping those constraints and global trade patterns evolving, alternatives are gaining traction faster than they would have in the old order. That doesn't mean an abrupt transformation. It means a gradual realignment where the world's financial architecture starts to reflect the multipolar reality already visible in politics and trade. Even with the clear trend toward diversification and the rise of credible alternatives, the reality is that the dollar's structural advantages are still enormous. Its role in the global financial system is not just about habit or legacy. It's about deep, built-in features that no other currency has been able to match at scale. Liquidity is one of the most critical. The dollar dominates global trade settlement, bond markets, and derivatives markets. If a central bank or large institution needs to deploy billions quickly without moving the market against itself, dollar-denominated assets are often the only place where that can be done reliably. This liquidity is self-reinforcing. Because so much is transacted in dollars, more participants hold and use dollars, which in turn deepens the market further. The institutional framework behind the dollar also provides a degree of confidence that is hard to replicate. The U.S. has transparent governance, an independent central bank, and deep rule of law traditions that protect investors' rights. For reserve managers, the predictability and legal protections of the U.S. system are a powerful draw, even when there are political disagreements. Alternatives like the euro and yuan may offer certain strategic benefits, but they don't yet combine liquidity, transparency, and accessibility on the same scale. The euro area has its own political fragmentation risks, and the yuan operates under capital controls and a less open legal environment. These limitations keep the dollar in a category of its own. Another advantage lies in the depth of the U.S. Treasury market. It is the single largest and most liquid pool of risk-free assets in the world. Treasuries are not just a safe haven in times of crisis. They are the benchmark against which other assets are measured. For central banks, this means that holding dollar assets comes with a wide range of investment options, from short-term bills to long-dated bonds, all of which can be bought and sold in size with minimal friction. This flexibility is invaluable when managing reserves that may need to be mobilized quickly during emergencies. Network effects also play a major role. The dollar's dominance in global trade invoicing means that many countries need to hold dollar reserves simply to facilitate imports and exports, regardless of their political stance toward the U.S. This is especially true for commodities like oil, which are still largely priced in dollars. Shifting these networks takes decades, not years, because they involve rewiring everything from corporate accounting systems to cross-border banking relationships. Even as new trade blocs emerge and alternative payment systems develop, the infrastructure that supports dollar usage remains deeply embedded in the global economy. It's also important to recognize that the dollar benefits from a trust premium during crises. History has shown that when uncertainty spikes, whether from financial panic, geopolitical conflict, or natural disaster, capital tends to flow into the dollar, not away from it. This flight to safety dynamic reinforces its central role and makes it more resilient to gradual erosion from diversification trends. Even countries that are actively seeking alternatives often increase their dollar holdings in times of instability. The picture that emerges is one of a currency that, while facing more competition than in the past, still occupies a unique position in the hierarchy. The shift toward a multipolar reserve system is real, but it's unfolding against a backdrop where the dollar's foundation remains strong. Liquidity, legal stability, market depth, and entrenched network effects give it a resilience that can't be undone quickly. This means that while diversification will continue, the dollar is unlikely to be displaced in any sudden or disorderly way. Instead, its role will evolve, slightly smaller in relative terms, but still central to the functioning of the global monetary order for decades to come. So, what we're witnessing isn't the sudden dethronement of a monetary sovereign, it's the beginning of a measured, multipolar world of currencies. The dollar is no longer the lone champion, but one among several contenders, and in this evolving ecosystem, financial resilience will belong to those who embrace diversity and yet still understand the value of stability